Normally it's that recording.
Yeah, it's there on the top. Showing up.
All right, thank you, everybody, for coming. Appreciate it. Especially thank you to the guests. And if we could get a roll call and start our meeting.
Trustee Rubin,
Yes.
trustee Hallwax, here, trustee Mealopolis.
All right, and at this point, so here's the thing. If anybody wants to make a public comment, I have 7 minutes of material I have to read. And if not, I won't. So if anybody would like to, I'll read the material. Otherwise, save everyone those 7 minutes. Okay, good. Seeing none. Can I get a motion to approve the minutes if they're okay, or does anybody have any comments?
Second.
All right, all those in favor? Aye. Right, minutes are approved, which brings us to the financial, annual comprehensive financial report discussion. Please take it away.
Margaret's going to kick it off for us, but we do have a big agenda this evening. Get out the audit first. If it's okay with the committee and the chair, we are going to move the actuarial report up before the financial report. Certainly our guests are welcome to stay, but also don't need to stay for the rest of our conversation. So I'm just okay with the committee will make a few changes. Okay, I'm going to hand it off to Margaret. And
all right, this evening, I think you said we'll start off with our audit presentation. And so the audit is a long process that starts with internal meetings to prepare for the audit all the way back in December. And then we have our first planning meeting with the auditors. We had it on January 8th this year. After that, the auditors come on site for our preliminary field work, where they are testing internal controls and taking sample data. And then the auditors are on site again later on in February and in March for the final field work. And that's a combination of them being on site in person and working remotely. After many weeks and months of work, we now present to you the calendar year 2024 annual comprehensive financial report, lovingly called the ACFR. And so this will be on the village's board agenda tomorrow night for acceptance. And if the board approves, and after the board approves, the audit will then will proceed to do all of the required filings, which are listed here. The village needs to complete a substantial amount of that before June 30th. And I'd like to recognize our staff tonight and thank Diane Harris, our accountant, for her work on the audit, and our entire finance team for all of their work preparing for the audit. It takes a lot of effort to pull all the documents together that are requested. I especially like to thank Nikki Larson for her leadership during the audit this year. And now I'd like to introduce you to Jaden Wilkie, our partner on our audit from Lauterbach and Amon. Our audit was led by Don Shaw and Joseph Ladon, and assisted by Katie Lagoya as well for the Illinois Department of Revenue, Illinois Division of Insurance Reporting. And so with that, Jamie, I'll let you go over some of the highlights of the audit.
thank you. Appreciate it. Thank you for having me this evening. I see a lot of familiar faces around the table. Hard to believe another year has come and gone, but here we are. So as Margaret indicated, I'll provide some high-level overview of the audit. As you can see, it keeps gaining in length every year, it feels like. So I think we're up to 167 pages. So I promise we won't go through all of those in detail this evening, but certainly want to point out some of the key areas of interest and kind of highlight some of the high-level financial results. I certainly want to start by thanking the village team, in particular the finance department as well. This is truly a 6-month process. There is a lot of back and forth communication, an extensive list of requested materials to satisfy our ongoing requirements of documentation in the audit space. Certainly that does not happen, and financial statements issued timely, which is becoming less of the norm these days, I will tell you that, without the efforts of the staff. So certainly really want to give kudos to them. They do an excellent job preparing and responding to our team. I will cover for the majority of this evening the large bound document you have in front of you. As with years past, I'll give some page number references so you can kind of follow along with some of the key sections of the report. And we'll start on page 7 of the document, which provides the Certificate of Achievement for Excellence in Financial Reporting. I do want to point out this is another review of the act for each year conducted by the Government Finance Officers Association, or GFOA. Really deem the highest level financial reporting that any local government can undertake. There are two key sections that get added to the audit to even qualify for the program and the award. That being the transmittal letter, which is directly prior to the copy of the award. I won't go through that in detail this evening, but certainly provide some background information about the village, economics, major initiatives, and policies as well. And then second, the statistical section, which is the last section of the document, and I'll highlight that towards the end of the presentation. So really a lengthy list for GFOA to meet that criteria. So we're happy to report that last year's audit did earn the award. And we are again anticipating this year's audit qualifying again for that award. Immediately after the opinion, you'll find on pages 10 through 12, the independent auditor's report. So current Illinois state statute does require that every local government undertake an independent audit each year. Technically, that is due within 6 months, which is why Margaret was referencing all those lovely June 30th filing deadlines. I do want to point out it is becoming a bigger and bigger deal for communities of your size to even be able to get their audits done timely. I will be very honest. I have been working in the audit space 24 years at Lauterbach and Eamon. This is probably the most units of government I've ever seen requiring extension filings. And part of it is because we've had some really complex standards. We've gone through a pandemic and some grant compliance requirements that have been more cumbersome for some communities. So I don't say it lightly that when we have a clean audit and a clean opinion, which we have, and things are done timely, it's becoming a bigger and bigger deal in our industry. So we have issued what we call an unmodified or clean opinion. The first two paragraphs on page 10 cover that scope. What that means is the financial statements as presented are materially correct. You'll see sections then also provided for management's responsibilities, that really being around making sure you have the right set of controls in place, you're taking responsibility for the financials and the results each year, and then our responsibilities as the auditor. So number one, we obviously want to provide that unmodified or clean opinion, but number two, we are also required to look at policies, procedures, internal controls, really making sure all those I's are dotted, T's are crossed, and we have a comfort level with the control environment as well. We do go through detailed testing on internal controls every year. You heard that we had actually dedicated time for that in the middle of January. Certainly, if there were any exceptions to our testing or findings, we would have to communicate those this evening. And we're happy to report we had no internal control related findings of that nature. Immediately after the opinion, you'll find, in my opinion, probably the most important section of the document. That will cover pages 14 all the way to, I believe, 26. That is what we call management discussion and analysis, or MD&A. So in a nutshell, this section has taken all 167 pages and attempted to condense them into a much more digestible part of the audit. Really intended to be geared towards non-financial folks, potentially kind of the breakdown of what are the high-level results that we need to know each year. What do we look like in comparison to last fiscal year? What are some of the major transaction classes? So things like capital assets and long-term debt, since they're material to the financials, we have some added discussion about those items as well. I do want to point out just on page 14, there's 5 kind of key high-level financial results for the year. Just to kind of take that snapshot. Overall total equity, or what we call net position for the village, did increase in comparison to last year. A couple of key things there as you kind of have a chance to go through the detail. General fund revenues continue to be strong. That was fairly similar to other municipal entities that we work with. So still seeing some of those strong state shared revenues, property taxes, typically coming in well. There were some deferrals of some certain capital projects during the year, so those will be kind of rolling forward to 2025. And then overall capital asset investment did continue for the fiscal year. So there was about 3.6 million in new capital added. And bonded debt remained relatively similar to last year. So anytime we've got addition of assets and kind of that long-term debt structure remaining relatively flat, we see an increase to equity for the year. So I wasn't going to go into like deep numbers dive. I'm sure Nikki and Margaret covered that stuff in detail, but really more the high level results for the fiscal year. I mentioned the last section of the document. I always chuckle because most people don't flip that far in the audit report, unfortunately. But there's really a wealth of information at the back of the document starting on page 136 that will take you all the way through the last page of the report. This, if you recall, is one of the additional kind of transparency sections that the GFOA requires for the annual award. But I do like to point it out to our committees and boards because there's really a wealth of information kind of packed at the back of the document. 10 years of history covering financial results. As you continue to kind of peruse through the schedules, you'll see 10 years of history related to property tax information, as well as long-term debt structure over the last 10 fiscal years. Kind of interesting schedules then as you continue to peruse through things like number of full-time employees and operating indicators through the village. Again, really providing in every schedule that 10-year look back. So I do always encourage, again, our committees and boards to spend a little time at the back of the report. Really gives a nice historical context to kind of what has transpired over the last decade for the village. So that kind of wraps up the ACFR, unless we want to pause here for any questions. Otherwise, I was going to go into a couple of the required communication letters that get issued with the audit as well. Great. So each year we do have 2 standard letters that we issue to the board. One is what we call our SAS 114 letter. Really nothing to note here, which is a good thing. So standard communication requires if we had any disagreements with management, journal entries that we propose that staff refused to post or disagreed with, use of outside folks that we weren't made aware of, if that makes sense. So I say it's standard because the village had none of those exceptions. So it's really the boilerplate language that is required under what we call our SAS 114 letter. The other letter that's issued each year is what we call our management letter. This is really our opportunity just to communicate future standards that are coming down the line. I mentioned that GASB has been very active. That is continuing. We do have a couple of standards on the horizon for both next fiscal year and the following fiscal year. We had a fairly significant standard in the current audit called GASB 101 for compensated absences. And I think we chatted about that last year when I was out here. The 2 that are coming, one is pretty insignificant in my opinion related to risk disclosures. The second is more impactful, meaning there are going to be some visual changes to the ACFR when we implement GASB 103 in the future. So there'll be some new terminology, some new sections of certain schedules. The budgetary comparison schedules will look a little bit different. And the MD&A is actually getting a refresh as well. So some things coming, we'll be working with the team on new templates and kind of making sure they have a comfort level with those changes. Outside of that, we really just had one housekeeping note on collateral, which was immediately rectified with the banking institution. So sometimes, depending on when certain revenue streams come in, there can be a blip or point in time where those deposits can be under collateralized for even a day or a half a day, depending on when the bank keys in and realizes that you've gone over your collateralization threshold. So I know that was immediately taken into account, but certainly we're still required to disclose that. That was all I had for the evening, unless there's any follow-up questions on the letters themselves.
One minor comment, but we'll send that along to you separately.
Yeah.
Typo.
Yeah.
Thank you very much, by the way. This is
A lot of
actually,
information.
I mean, I realize
My background in accounting, so, you know, with that in mind.
But it really is a wealth of information here if you stroll through it.
Yep.
Even if you skip the parts you know less about, there's a
Right.
lot of
There is a lot.
interesting things in here if you're interested in the village.
Yep.
So thank you. Thank you for all the time you guys put into this.
Thank you.
Nikki and I were just mentioning that the village's EAV has increased $400 million in 10 years. It's a stunning number in the context of other communities. So good news stories.
This is related to the visit of the assessor.
Yes, half of that went to his house.
More than I
It's
wanted.
reflected in his assessment.
Thank you so much.
Thank you.
Thank you for having me. This
Nope, and we know you have another.
I'm headed to the
Welcome
park
to the Park
district. I
District.
have a same meeting tonight. It worked out well.
Keep
Appreciate
them
it.
in line.
They're pretty good. Thank you, guys. Thank you.
Thanks, Danny.
All right.
Nice to see you all.
And next, we'll hear about pension. Please. pension fund.
Yes, yeah, so there is a fire pension fund as well, and I'll just touch on that briefly. I don't bother to bring a report. There's one participant in that fund. She is 93.6 years old as of the valuation date. And she's,
6.
yeah, 0.6. And she's getting an annuity of about $48,000 per year. That's not going to change. So each year you basically fund that on a pay-as-you-go basis. Just to touch on that and acknowledge the existence of it, but we will focus on the pension. That's fine. So with that, I'm sure everybody's page 5. That was,
I think everyone's met you, Heidi.
Oh, I'm so sorry.
If anyone doesn't know, Heidi Endorfer is our actuary with Foster and Foster, so.
appreciate it. Sorry about that. I recognize so many faces. I didn't even Okay, so on page 5 of that report, we have the bottom line on top of it. This is a summary. This is your one pager. You needed to walk into a meeting with all of the actual numbers that you're ultimately going to need. This page will cover that. At the top, we do have the funded status. You focus on that leftmost column. That'll be this year's numbers. We do show another column of last year just for that year-over-year comparison. We see that there is a slight improvement to the funded ratio year-over-year. The contribution did go up a little bit year-over-year, 6.9% increase. That was the result of a few different things. First of all, the nature of the methodology that we apply to the amortization of the unfunded by default will basically is defined to increase that every year. So you're going to amortize a little bit more each year, and that's going to naturally increase this number year-over-year. So that's part of it. There was some unfavorable plan experience. And then we did make one assumption change. This was scheduled again based on the funding policy. So your funding policy was grading down to a lower payroll growth assumption. This year you hit this final assumption of 2.5%. Next year that's not going down anymore. And the next year what will happen is we actually will start to do rolling amortization as well. So at this point we are still amortizing 16 years. Next year will be 15 years. At which point we're going to stick that 15 and then apply a rolling amortization methodology. So that's coming.
Mhm.
That being not reflected here is also part of the reason you have that increase. Once you start rolling, you'll start benefiting from that, but you're not there yet. In terms of that unfavorable plan experience, few things are the result of that. The most morbid thing I get to say, and I have to say as an actuary, inactive mortality was unfavorable when nobody died. You still have to keep paying annuities. So that's part of what happened with liability here. The other piece was on the asset side. So we smooth assets over a 5-year time frame. That is why you're seeing a return of 5.93% here on an actual smooth basis. We take into account the last 5 years, gains or losses relative to the 6.5% assumption. And if you recall a few years back, everybody saw a significant return. We're still absorbing that. And that's why this is a bit muted from the market. Smoothing's doing what it's supposed to be doing, because in those down years you didn't have to absorb all of that at once, but now we have to put that in over 2 years. Eventually that goes away, and hopefully we see that first, but right now we're experiencing losses as a result of that. So that's what's happening. With those two numbers there, I'm going to touch on page 6 briefly. This does highlight that reduction in the payroll growth assumption by 25 basis points. said we're done reducing that assumption. We won't be reducing that. What that does in effect is it does increase the contribution this year. But it means that you're paying more unfunded liability each year in principal. So you're seeing more of your annual payment going towards paying off that unfunded. So it is a good thing to have a lower assumption there. 2.5% is as low as I see most funds at this point. So you guys are in a nice conservative place. I feel good about where you are with that. Otherwise, this page is relatively boring, but I did want to touch on a couple things that could be coming and possibly as soon as next year. You probably have heard some buzz about changing tier 2 in your fund. You have over 70% of your population in tier 2 right now. So should that come true, you will see a significant increase in liability. All of the benefits being floated are definitely increases to liability. It'll probably end up being some sort of political exchange where they kick the can down the road again in exchange for higher benefits for tier 2. That doesn't do you any good for this report though, because you're following your own funding policy. You're not following statutory minimum. You're doing better, and you should be doing better, but that's sort of the happenings down in Springfield and what we think will happen. How high those tier 2 benefits will be, it's still to be decided. I don't think they'll go all the way up to tier 1, but directionally what we continually see on the table is moving the retirement age down to match tier 1. And that's going to be the biggest driver of that cost. You're starting annuities 5 years earlier than you would be otherwise at an unreduced level. And so that's going to drive that cost up a bit, bring tier 2 closer to the tier 1 level. That's still being discussed. It's been discussed for a couple of years, but at some point here, I think it's going to happen. The other thing is that you right now largely rely on a lot of assumptions from IPOPIT for your demographic assumptions. Most funds in Illinois are too small to come up with their own full set of retirement rates, full set of termination rates and such. So we do lean on that larger study that consolidates all of the Article 3 funds across the state, and we do use those for demographic tables. In 2026, IPOPIT is doing another study. I don't know that that'll be completed early enough to incorporate into your report next year, but in 2027, we'll likely see some assumption changes as a result of that. At that point in time, we can revisit whether we want to stick with the 6.5% interest rate assumption or whether we think there's merit in increasing that, depending on what the investment policy looks like at IPOPIT, where most of your money is right now, and depending on your funded status as well. Because keeping in mind the lower funded status, if you do pull back some of that in cash locally, it'll be a higher percentage of your fund than a better funded. Okay, so mentioning those 2 things, let's get into the meat of the material. And I am going to show you a lot of numbers, unlike Jamie. So, page 7, a lot of numbers here, but focusing on.
Before you, okay, good, page 7. So I have 3 column headings.
Okay, yeah.
And then that continues the next page, and then it gets even more interesting. Following pages, because the numbers, like on page 10, I've got the first 2 columns, but then what's underneath them are different, whereas, so what?
So in the course of reviewing this, we
Did we
changed our
glitch?
we changed our report system this year, and I realized our new report system has a glitch that it didn't pull in the headings to say new assumption. The only difference between these 2 columns is the 2.5% for the assumption. It's already been recorded to the IT folks. Unfortunately, I found it when I was taking notes for this because I was so focused on getting the numbers right when we issued the report. I did notice that. But it is the new assumptions are on the very leftmost column. The middle column is old assumptions. All it is the payroll growth assumption. So on most pages, these numbers match. The only page these columns don't match is on page 10, where we implement the amortization of that payroll growth. So I apologize for that. Yeah, that's a good question, a fair question, and hopefully be fixed in the future. On this page, on page 7, there's 3 sections here. The participant data at the top. So this is showing us the data we collected from you guys to perform evaluation. This is snapshot valuation data. So whoever's in the fund on the valuation date, whatever their status is on the valuation date is what's included here. So to the extent somebody retires on January 5th, we'll roll that into next year's valuation. So usually people are sitting in the room thinking, well, I know this person retired and this person died and they have all the activity that will be picking that up next year. Page 24 does show a complete reconciliation of that. So there's very little activity in your funds year over year, though. You'll see that you had 1 new hire that increased your counts from 31 to 32. and you had one person that was hired in term within the same year added to your terminated investment accounts because they are due a refund of the very small amount of contributions that are still sitting here. The next section here is the assets. So we have actual value versus market value. Again, I mentioned that we do smooth over a 5-year time frame. We are still smoothing in that significant loss from a few years back. If you look at the 2024 column, you can see the relationship to your actual value and market value shows that actual value is about 4.4% higher than market. So that tells me you had deferred losses that are outstanding that are not yet being reflected. This year, that's tightened up a little bit. We had some gains again that are offsetting part of that loss. So you're within about 1% at this point in time. Those are converging just like they should, and that's exactly what the method should be doing. So hopefully next year we see some positive returns and that crosses over and we actually see that relationship reverse. The last number I'll point out on this page is the very bottom of that leftmost column, $87.1 million is representative of the liability for all 88 people in the fund today if every actual assumption that I made came true exactly. So basically, if you had $87.1 million in the fund today, it'd be fully funded on those 88 people if all of the things that I'm predicting happen.
Everyone dies on time.
Everybody retires, dies, disabled, everything happens exactly that. It's a lot to happen. So obviously we do track that annually and readjust, but that's what that number represents. It wouldn't be a number you'd fund to because not all of that has been earned yet. Your actives are still working, they're still earning those benefits. So on page 8, we actually split that up. So if we look at what has been earned to date by your actives, up near the bottom of that leftmost column, $77.2 million is the liability for service that's been earned to date. We compare that to your actual value of assets. That gives us the unfunded actual accrued liability of $31.7 million. That's basically service that's been earned that has yet to be funded. Basically, the village has a mortgage outstanding that's paid off annually towards that amount to bring that to eventually zero. And then that gives you a slightly improved funded ratio from last year of 58.9%. The last number I'll point out on this page is near the middle of that leftmost column. Total normal cost of $945,000. That's the value of your active population of earning 1-year pension benefits in the fund right now. Now that's with the benefit structure in place. That does go up should tier 2 benefits become improved. So
What would the estimate, what that would look if we have a look at that another day maybe?
If it were to change,
Yeah, let's say that the worst case scenario, let's say that the most aggressive tier 2 change happens. Like what happens to that 944?
So if we look at, I'm going to flip you to page 10 because I was going there next anyway. The way I like to look at it is as a percentage of payroll. If you look at page 10 and the normal cost listed there, 24.8% of pay. That is a combination of tier 2 and tier 1 pay. Tier 1 is probably closer to 30%, and tier 2 is probably closer to like 22-ish%. And so when you blend them, you're getting the 24.8. So there is probably an 8-ish% or so gap between tier 1 and tier 2. So to the extent you were to move all the way up to tier 1, you can add, a bit to that and assume this number goes up to more like 30% of payroll. Now that is offset by that 9.91% of contributions that the officers make themselves, but in the end, you're on the hook for the delta there. So
that could go up $250,000.
potentially.
Yeah.
And again, lots of things are on the table with respect to the event to end up looking like, but
you and I are on the Northwest Municipal Conference Legislative Committee. This has been coming up because there's been different bills and different concepts that have been floating past. And we did work with Foster and Foster to try and game out one of the scenarios. The challenge in it is that it seems like sometimes by the hour, the proposals are changing, which can wildly skew the numbers. But I think at least this gives us kind of a ballpark estimate, but once that happens, we're going to have to take a look at how much it's going to cost us and how to fund it going forward.
And it's hard to say what's going to happen. I think to Nikki's point, we have heard through the Northwest Municipal Conference that the governor is not a fan of moving forward with any tier 2 enhancements because he recognizes the substantial impact that's going to have on the state's own pension plans as well. So there's a whole series of negotiations that are going on. We're hearing there may be a veto session They may be doing a summer session. They may bring them back in the fall to go through this. Nothing has happened yet outside of some enhancements to some of the Chicago pension programs, but not to the other downstate programs. But we're keeping an eye on it.
And it is interesting. So the whole tier 2 issue with a lot of the other state plans is that there's a safe harbor threshold that is not being met by those funds to basically escape paying Social Security
Right.
because of the pay caps and such on the pay that's allowable in the fund. This fund also has that cap on tier 2. However, because of some of the earlier retirement ages that are allowed in the police ranks and such, it really isn't likely to be an issue for a lot of funds in Article 3. There could be a fund or two where things happen eventually, but and you might be more subject to that just because you're probably a higher paid police force than some of the other downstate funds, but it's a much longer tail on these funds and the things that are being considered to fix it in addition. The real fix is just increasing that pay cap to Social Security wage base. That's the simplest fix, and that's always part of this. But the other things that are getting rolled in with this are reductions in that retirement age and some of these other things that are probably more related to recruiting and retention of the police force and that inequity between tier 1 and tier 2 that the officers do. They can recognize, but it becomes more of a recruiting or retention issue. I think that some of those other things are being floated.
Right.
So back to page 10 here, we do show you all the components of the calculation. Normal cost at the top is about 1 million. We do apply interest here because these numbers are paid on January 1st, paid later in the year. Add to that the administrative expenses, and then you subtract from that the expected member contributions, about 402,000. That would be your annual ongoing contribution if you were fully funded. However, I did mention we have that amortization payment to pay off that unfunded actual liability. That's the $2.8 million number in the middle of that column there. About 82% of the recommended contribution of 3.4, about a little shy of 3.4 million, is attributable to that amortization payment to pay off that unfunded actual liability. So I guess the good news is if that was paid off, this becomes much more manageable. It's the paying off that becomes the issue. And so your funding policy you put in place will start to mitigate what that number looks like, because every year you'll push out that amortization payment to grab one more year of taxpayers, and then you'll spread that amortization over the next 15 years of taxpayers on an annual basis. So in terms of funding policy, it's a very sound method to do that. You're not, what you were doing before was boxing in your taxpayers between now and 2040 and saying you're on the hook for all of our unfunded, and taxpayers after the year 2040 are completely off the hook. So the methodology that's employed now has an equity component in that you're continuously smoothing this over future taxpayers. So I think that will work well for you. We'll see how that partners with the potential benefit changes that come through, and I'm sure we'll be looking at making our team on what that looks like for you. Okay, so the good news is, one last thing I'll point out on page 10 is that the village is taking these numbers seriously. The village did contribute 100.6% of the recommended amount for this time frame. So that's always good to see, and I do like to highlight that when I get to say that out loud, because I don't always get to say that. So that is good to see. So on page 11, we have a reconciliation of what impacted that contribution year over year here. So at the top of the page, last year's recommended amount is listed. This year, at the bottom is this year's recommended amount. See that $217,000 increase. And you see there's several buckets here that contributed to that. So the normal cost went up a little bit. You have one more person accruing benefits. So you're going to have to pay a little bit more as they're accruing. Inactive mortality is mentioned. No deaths in the fund means that the contribution is about $48,000 higher than we anticipated as a result of that. And then that payroll growth assumption. So it was 2.75% last year. So as a result of that, you could expect, with all of the exact assumptions coming true as I expected, $71,000 increase in payment, regardless of the rest of the stuff going on here. And then that assumption change is 45,000, just dropping that payroll growth rate 25 basis points did increase this contribution by that 45,000. So it was various components that did contribute to that increase year over year. Page 12 just shows you at the top here the impact of what that rolling amortization will look like. So We start going to the 15-year next year, and then that plays out. You can see in 15 years, and 16 years from the 2025 year, you're still sitting with about $21 million unfunded, just based on that methodology that's in place. But in that time frame, I'm sure we'll revisit the funding policy and see what the situation of the village is at that point in time. A funding policy is generally something you want to revisit on a 5 to 7 year time frame, just to make sure it's still working for you, and we'll look at it at that point. Looking at the charts here at the bottom, salary increases, market value of assets versus actual value. The good thing to see here is that our actual assumption versus the assumed for that time frame goes both directions. Some years were higher, some years were lower. So we do monitor this to make sure our assumption is doing what it's supposed to be, which is predicting the future. To the extent that we see something going in one direction or the other, we will start to tame that in and propose an assumption. I'm not seeing anything here at this point in time. All right, so on page 14, just showing you that amortization here of this is the 2.5% rollover. At the beginning of the year, payments about 2.6 million. That will start rolling next year. So we'll start to see the impact of that rolling, bringing that annual payment down over time. On page 15, this is a new page in the report here. This is showing us a history of the funding progress. Now, what it doesn't show us, it shows us where the funded status has been, and you can see it's been relatively level over this time frame. What it's not showing us is where there's been assumption changes or benefit changes or huge market dips. So if you were to look back historically between 2018 and 2019, we did make some assumption changes there. There was a benefit change to tier 2 between 2019 and 2020 that brought the tier 2 benefits up a little bit. There was a market dip between 2022 and 2023. So there's a little bit of noise there. Now with the smoothing, it's harder to see some of that, but this does give you an idea of where the plan's been over that time. Page 16 is a projection of the benefit payments in the plan. So the total payments at the top in the 2025 row were expected to be 4.5 million. That's about 10% of your market value of assets. So just to estimate, you're paying out about 10% of your assets on an annual basis towards benefits. Just to give you a sense for that. It's relatively typical. I'd say most funds are in the 8 to 10% range. I've got few funds where it's 20 to 30%, and those are much different conversations. Fortunately, your assets are largely able to stay invested and probably largely funding this via cash flow and not having to touch your investments too much. I'm looking at page 21. So what I put past was the details on the assets. If you wanted to go through the calculation detail there, but effectively shows you how the smoothing works. Page 21 is a visual to show you what the smoothing looks like. So at the top here, we do show you the history and the actual value versus market value. You can see that the actual value is a much more steady line. The market value jumps around a bit. This is what the smoothing is doing in effect. You see that with the actual returns, the chart at the bottom where the market return is jumping all over the blue line. And then the green line is the smooth return. So it helps mitigate the volatility there, which is exactly what smoothing is supposed to do. Page 22 is a summary of the data that we collected to perform the valuation. So focusing on that leftmost column, we do show you those tier 1 versus tier 2 splits. This is where I'm showing you that 72% of your population was tier 2 as of the valuation date. I suspect that's probably higher today. So when those tier 2 changes are implemented, it is most of your population that's impacted. In terms of your retirees and beneficiaries, they're slightly older than average, telling you we have a little bit less time in annuity. In the annuity period for your retirees versus other funds, similarly with your disabled. And then just to point out on your terminated investments, 8 are listed, only 3 of them are actually due annuities in the future and carry any significant liability. 5 of them are simply due a refund of their money should they come request that from the fund as their own employee contributions. They earn no interest on that, so your fund gets to keep their money invested until they come. Page 23 is an age and service distribution of your active population. So you take your 32 actives and bucket age along the left-hand side, service across the top. And if I focus on the bottom left-hand corner of that page, I look at anybody with more than 20 years of service who's over age 50. There are only 2 people in that category. Back that off 5 years, and I look at anybody with more than 15 years of service over age 45, I add 2 more. So in terms of how many people could retire in the next 5 years, you only have 4 people that fall into that category. So the good news is you're not going to see a run on your bank for annuities. Nobody's going to be eligible in that short of a time frame. So your annuity stream shouldn't change significantly. The reason this came about though was because when I look at 2023 and 2024, you had 2 retirements in 2024, you had 4 retirements in 2023. That's very typical what we've seen in policing these days. Hopefully that's kind of run its course and we see a reversal of that, but not many folks that are left to be eligible for retirement. Page 25. Just highlight, we do have a 4-page summary of your assumptions here. 6.5%, I'd say at this point in time, you're on the conservative end with that assumption. I feel comfortable where that sits today. While you're just shy of 60% funded, you are having to maintain more assets as a percent of your portfolio to pay benefits. So I feel comfortable with that. But that is something we'll want to revisit when we look at assumptions again in a couple of years. Do we see merit in moving that up to 6.75% maybe? We'll see where the markets are at that point in time. It is worth noting that IPOPIC is valuing your fund using a 6.8% assumption. And again, we'll see where they land in a couple of years as well. Let's turn now to page 29. And this is the last thing I want to highlight for you. There is a 3-page summary of Article 3 as it stands today here for you. Should you have any questions about what Tier 1 versus Tier 2 looks like, keeping in mind a lot of the proposals around the Tier 2 changes are moving things directionally towards Tier 1. So for example, that normal retirement age of 50 and 20 years of service is one we see floated a lot when we're hearing about Tier 2 changes. So right now, Tier 2 can retire at 55 and 10 without any reductions. A lot of the proposals on the table are moving that down to match Tier 1. So that's a big change that will likely come. I think almost every proposal I see these days is addressing.
The age is, the proposal is to drop the age but not increase the years of service?
No, both. So 50
Okay.
and 20 for unreduced.
I got you.
Yeah, for unreduced. Basically to match that. So with that, are there any questions from me? A lot of information, I know. And I am available later. I know it's a lot to take in, so should you have any questions later?
So the bottom line is a contribution to go up by whatever, $218-ish thousand.
Yep.
And we're still contributing more than the minimum, than the state formula
Absolutely.
minimum by material amount.
You are, and we do actually have that calculation in the report based on your assumptions. The very last page of the report on 39 shows you that statutory minimum required contribution. This is based on these assumptions, not the IPOPIC assumptions, which will be another set of assumptions. But either way, you're definitely working that. And we do monitor that.
Yes.
So you have to be saturated.
Right, but I just was like, we want, we intentionally are well ahead of that because of, close that gap of unfunded.
Absolutely.
I have a quick question.
Sure.
If you look at page 15, the funded ratio is 70%. And that's using the smooth returns from page 21, correct?
Yes.
So, given fairly healthy markets since 2020 and a very much higher interest rates, even with smoothing, we're still where we were at 2019.
So
So it means that to think that we're going to get rates to move up 400 basis points and markets to double again in the next 5 years
I am
is
not,
probably not going to happen.
probably.
If we had 8% rates, the country would be bankrupt. So just, I don't know how this funding ratio ever goes up.
So
Because most terminated pension funds, like all of ours, we're all 105 and they're all done, closed. And, so as long as they're open, it strikes me this can never get better.
So I think it's important to keep in mind the last few years here have had losses consistently. When you have too much retirement experience, and we've seen that in policing, those are going to cause losses because you see people starting annuities earlier, they're starting to pay benefits earlier, that's higher liability.
automatically, the day they retire, they've increased your liability from what they were before, because they're retired earlier than we predicted. The last 3 years, you've definitely experienced that. The other thing that's happened over this time frame is you're addressing a very small sliver of principal on that unfunded actual accrued liability, because you're still working your way down to that 15-year amortization. So at the beginning of this, you were at 25-year amortization or whatever it was. And so as you worked your way down, you address a bigger and bigger component of the principal on that unfunded, but it still was a pretty small amount and not enough to overcome some of those losses from retirements and such. So that could go either direction, and we do monitor our assumptions, make sure we're putting appropriate assumptions in place, that we're trying to predict this as best as possible. But some of that retirement experience last few years just wasn't baked in here. And so that's also being reflected. So while the market's doing well, liabilities weren't.
The major loss that we had was the consolidation because everything was revalued. So we took, it was a 6-digit loss when everything was revalued in 2022. You can see the dip on page 21 when all of that happened. So the hope and the idea, the theory, believe it or not, is no consolidation as they start to place investment managers, which they're still not done with, that the investment returns will be more of the likes of what we see with IMRF and less of what we would see when the individual funds are managing them.
Yeah, we clearly have not seen the benefits yet,
We have not.
the promised benefits.
Well, they did indicate that it would be years before those benefits began to be realized. My memory serves, it was 3 to 6.
We get all the investment
Yeah.
managers placed certainly.
Yeah.
I can tell you, we just, we've done a study for the fire side already. They did an experience study this year and the market returns. So we basically in that study, we do look at consolidated investment advisor predictions for the future. So we're not investment advisors, so we do lean on the authorities there, but we take the experience from multiple funds or multiple fund advisors. And because everybody has a different opinion of what the future is going to look like, consolidating that and looking at how the fire fund long-term investments are intended to be placed, they're looking at a long-term rate on like it's a 50th percentile, closer to like 7.5 or 7.6%. So to the extent that the police does something similar, now they have been slightly more conservative than the fire generally, but even if they got you up to 7.25 on a long-term basis, that's better than your 6.5 that we're assuming right now here. And hopefully we'd realize some gains over time. But now that's all big ifs. We don't know if they will perform at those levels, but based on the investment policies they put into place, that's the hope. And once you start going to this 15-year amortization, you are addressing a bigger sliver of that principal on your unfunded. So hopefully your funded status it'll slowly improve. It'll take time, but hopefully you start to see improvement with that just because you are working with it's a long enough period. 15 years is a long enough period to absorb some of those shocks to the market or gain loss and liabilities that happen. It's a long enough period to smooth that over where it shouldn't be too painful, but a short enough period that you are actually addressing some principle on an annual basis and not just these slivers that you have been kind of hacking away over time. That's the problem with what the exchange with this tier 2 stuff is on the statutory basis. And the kicking the can, every time they kick the can, you basically stop addressing any of that principle on the unfunded accrued liability, and you don't make any progress. You keep treading water at best. But your funding policies are sound.
And I'm looking at this, the last time when we generated the funding policy that we have now, that was in 2021. So we're coming up on that window of time where we need to revisit it, and this might be great timing depending on what happens with tier 2. We may have to just take another look at what we're doing to see if it still makes sense.
And if you have any questions later, feel free to reach out or reach out through me either way. I'm happy to answer any questions that come up.
Thank you.
Thank you.
Thank you very
Thanks.
much again, and thanks for all the work that you do. Brings us to our review of our monthly. financial.
Okay, so we've been talking about doing this for a long time, since as long as all of you have been on the finance committee, maybe a little bit longer. Last time we tried to modify the financial report, we took everyone's suggestions and the report just got longer. So what I think I've been hearing is that there are parts of the report that are just not useful. So what we want to do is get to a point where the report is useful to you, that it makes sense, and you feel confident that you're getting the information that you need. So we made some changes this time around in the format. Wasn't anything crazy, but we're trying to streamline a little bit and get rid of some of the repetitiveness. So we took the financial projection narrative section and incorporated that throughout the report. We took that off at the end. We also modified the sales tax reporting section, incorporating that quarterly data right into the report, and placed the monthly comparison data back into the appendix. So we didn't lose that, just a little bit further back in the report. It's getting a little bit long. We also added summaries for additional funds that we've been just kind of high level summarizing, but they're pretty big funds. The debt service fund is really just an in and an out, but from a dollar standpoint, it is significant. From a financial perspective, when we're paying all of our debt, it does accumulate a lot of resources, and we pay a lot out of it. As well as the capital projects fund, particularly this year with the golf clubhouse project, there are a lot of dollars flowing through that fund. The motor fuel tax fund is a little bit smaller, but still we wanted to put that in front of you. And then also added the police and fire pension funds, similar to how we compare the rest of the funds, just kind of give you that green light, blue light, yellow light kind of warning signs there. And then we also removed the rolling 12 graphs. I don't know if anyone misses those, but I'm sorry if we need to add them back in, we can. And then we also took out the property tax distribution chart, not really getting a sense that that was valuable to anyone or providing a lot of information. So I would welcome, if anyone's concerned about any of the things that we took out, or if there's more things that you would like to see, and if you want to think about it, that's okay too. If you have feedback now, that's fine. But I think we're just trying to make sure that this is valuable to everyone. All right, with that, I'm going to walk you through the report, but please, if you think of anything later, please let me know. I'm happy to talk through that. On the general fund side, our property taxes are more than last year. We're about halfway through the year and about halfway through the budget. We're exactly where we would expect to be, having received the first installment actually on time. So this is where we would expect. We received about $20,000 in May. I'm assuming from folks that have had successful appeals of their property taxes and are now paying past the deadline. Their amended bills. It's about $18,000 more than what we were projecting for this month. I would say we are still receiving information that the county is going to be late with the second installment. There's some optimistic projections out there that it's not going to be.
What was the paper kerfuffle that is causing this? That they didn't get their filings of some sort in?
That story.
Yeah.
The story that was published in the Tribune was that they were launching a new Tyler software, which is a sore spot for all of us.
We can
It's the software
empathize.
we use here, and that it was not functioning properly. But if you read the Tribune article, there's also an allegation from President Preckwinkle that the assessor was not properly prioritizing what needed to be done by the deadlines that needed to happen. So
It's
I'm sure the
probably
truth
both.
is somewhere in the middle.
It's probably both. We can't begrudge their struggles and frustrations with anything Tyler Technologies related. They were building out a custom system with Tyler. Tyler is probably the largest at this point ERP developer in the world. And they are seen as really kind of the only option in many cases, particularly with something this large.
And ERP would stand for?
Sorry, Enterprise Resource Program or platform. I always forget. Program. It's basically your financials and all of your data systems pulled together into a single database. Tyler is a challenge. They are a huge organization with many, many different products, and we would not be surprised if that was a significant. The transition from what was essentially a DOS-based program to a new system like this is a challenge by itself. And then you add the customization, and it's a whole nother set of challenges. But our sense is that they're not, the bills are probably going to be late, but not very late. It could be 2 weeks, it could be 4 weeks, but they should be, I mean, on a regular cycle, they'd be coming out around the 1st of July with an August 1 or so due date.
The big concern that I do have, and I just want to warn the committee about, is the volume of increases that we're seeing in assessments, especially in this area. We did have a meeting with the Cook County assessor last week that explained how they are modifying their valuation and justifying that compared to what properties are selling at market value. They certainly believe that their methodology is sound, but they also provided a lot of resources to our residents that we'll be sharing out on how to appeal if they disagree with the assessment. The underlying concern that I have with this trend is that I do think we're going to see a lot more property tax refunds and a lot more appeals this year. And what happens when they do that is the county will just deduct that amount from any distributions that we would be having coming to us for this year. So say we levy property taxes for $5 million and we're supposed to get $1 million in July, they'll just take, someone gets a $50,000 refund, they'll take the $50,000 back right out of that. So we won't get the full cash amount that we've levied. It's a timing issue because they did change the law a couple years ago that the county realized that municipalities were not realizing what they were actually levying in taxes. So they do a true up, but it's once a year in November, and it's a year in arrears. So it is possible that our property taxes will come in less than what we expect to receive this year, but that should be trued up in November of 2026. So it should just be a timing issue, but I do expect with all of the values coming in high,
It's gonna be a big.
we're gonna see some deductions.
Okay, but
The whole deadline already passed.
Yeah.
So if they're
Well,
coming
the
out
first
with
one.
The first one, yeah.
The multiple ones.
There are, but
There are,
Yeah, first
and
round, yes.
sometimes we see properties stuck up in appeal for a long period of time.
Yeah.
And there's also a process that it has to go through with the county before it's processed as a deduction. So we can see property tax appeals. I mean, we can have deductions right now that are from 2018. So
Mine is from
they're
2021.
erratic. Yes,
Is it this year?
so they are erratic, so we could see this pattern for a while. The good news is when you think about it holistically, we'll still get the money that we're requesting, just might be a lag.
You keep, all right, so address that point. My understanding was that Cook County was essentially funding back some of the refund amounts, some or all, I don't know. So how does that work? You first they take it from you and then later on at some point they give it back, and ultimately it just comes out of the county's pot, not ours?
So what happens in Illinois, which is different than other states, because other states have tax rates, but in Illinois, municipalities ask for a dollar amount. So say we levy $5 million, and as of December 31st, we've only received $4 million. The county will look at that and say, we've shorted Glencoe by $1 million. So when we process the property tax levy for 2025, but collected in 26, we add $1 million to the top so that you get that money in the property tax distribution in November. So they just add it to the following year. Whatever you didn't get they add it to all the bills to
Is that
collect
part of-
from the residents.
part of PTOP? The limit on what we can.
It's outside of PTEL.
It's outside of that.
It's outside of PTEL.
We have
And
had this situation happen.
we've had it several years in a row, and
Yeah.
sometimes it's significant. It's a
Hundreds of
genius
thousands.
way of the county redistributing taxes. So you may be successful in your property tax refund, and if
My
you get
neighbors
10, your neighbors will pay. So if you get $10,000 back, your neighbors will get
It's a big
$10,000 more.
balloon,
Got it.
right? You squeeze it here, it's someplace else. It's
Got it.
the same, the number stays the same.
We
Thank
may
you.
have some erratic.
Well, especially
distributions coming
given
our way.
the last year and this year, the bumps, the crazy.
Yeah, with the full reassessment of New Trier Township this year, the assessor acknowledged, as well, it's gonna be a big appeal year. And that process gets bogged down in itself as well,
Yeah.
which doesn't help the timeline. Some of those tax bills go unpaid until the appeal is settled out.
And
Really?
for that reason, they
Sometimes.
delayed this year's tax sale.
Yeah.
Entirely to next year because they realized that there's a backlog.
That the board review can't keep up. And this is kind of the tension also in the county between the assessor's office and the board of appeal and the president's office. So you just have this, it's a very political environment that isn't resolving easily, especially with reassessments happening throughout Cook County, but particularly in these areas of Cook County. It only adds to the workload.
So more to come.
We're keeping on
Wish I
it.
had better
I
news.
understand.
It's
but
fascinating
keep
stuff.
an eye on it. The other thing I wanted to talk about was sales taxes. This month's distribution was more than last year. We're running about 32,000 more than what we projected for the month. And this was February sales. We're at about 42.5% of budget, which doesn't mean much with this being seasonal. But the other change that we're starting to see with sales tax is going up and use tax is going down. Because of a legislative change that was made. You might remember a few years ago, they made a change with the leveling of the Playing Field Act, where a lot more online sales were applicable to sales tax. And that was kind of making the shift from use tax to sales tax, but also just overall growth in sales tax in general. My understanding, I was on a webinar with Department of Revenue this morning. There are only 3 categories of companies that will continue to pay use tax, one of them being online wine sales or like imports from wineries from out of state. Their goal is they're really shifting more to sales tax buckets. So they were very clear to say that we won't see a 1-for-1 change because there are a lot of underlying changes in this law of how that's going to play out. But generally, as we start to plan for next year's budget and as we look for projections as the year goes out, we'll see that use tax start to decline and the sales tax will climb up.
I had a question about sales tax. It's split on 2 pages, but on page 18, top of the page. So the first actual category with a number that's not just carryover, automotive and filling stations. Did no one buy a car in Glencoe during that period?
We were looking at that, and I do think it's a timing issue. We requested all the reporting for that time
Yeah, that
period.
can't be right.
The other issue at play here, I wish I had a better explanation for this, is that the Department of Revenue also had an issue with their reporting.
Well, you think that our automotive and filling station dollars should have gone down 90% almost? I don't think so.
So they claim that this reporting has been corrected, and Margaret and I are waiting for the updated report.
And the check.
Yeah,
Well, the interesting thing too, though, is if you look at drugs and miscellaneous retail, that's gone up 130.
Yeah, right.
Right, which is a huge jump.
Which is also probably wrong.
Probably, right. And so we've been trying to rely on these numbers for a bit as we've been looking at a few things. And as Nikki said, Their reporting has just been.
It turns out if you bought drugs, they gave you the car for free, and that's what explains it.
Yeah.
Interestingly, the actual distributions don't reflect that. So I think we have some reconciling to do here with what they're reporting versus what they're giving us.
Okay, right. So as long as we stay on top of that, because I'm guessing we're owed money.
So, a good news story, income tax and utility taxes are up, so that's good. We do have a few revenues trending down for the year, as you can see from the projection spreadsheet. Places for eating, it shouldn't surprise anyone that that's going down, for sure, up with lows. Hopefully we'll see that kick back up again. Use tax we just talked about, personal property replacement tax, that's still a remainder from the Department of Revenue's error over allocating. And now with this most recent budget, there are continued diversions from PPRT. So I don't see that revenue rebounding anytime soon. So you'll see that in our projections as we start to get into revenue projections for next year's budget. And cable franchise fees are just slightly down.
One thing to note,
Permits are way up.
permits are way up.
Way up.
One thing to know relative to places for eating, not just actually.
Oh, really?
No.
Others too?
We haven't really issued any permits for Uber Eats.
Oh, really? Oh,
We
okay.
have them in, but we haven't issued them. So it's,
Oh, okay.
there is more construction activity going on in town than any time that I can remember outside of the Hoover State.
Wonderful.
So it's a busy time. Places for eating tax, Mensch's is planning to open tomorrow.
Oh.
They received their certificate of occupancy today, so they are raring to go. That's a good thing, lots of excitement, folks waiting for that one, so.
The expenditure side of the equation, we're running higher than last year, but still within budgetary targets for the year. When we look at annual revenue projections, despite all of the bad things I told you tonight, we're still projecting that we would end the year at 470,000 over the revenue budget. So we still have strong performance in a number of our revenues that will carry us through that. On a projected surplus deficit, still planning on drawing down $3.5 million this year, which is a little less than what we had planned. But that I would caution that number will still change as we get further through construction season. Fund reserves at month end unaudited. I did not update any of the audited numbers yet. One would be presumptive that the board would accept the audit, so we'll do that next month. Was at 16.6 million, which is 58% of operating. On the water side, still good news stories, volumetric revenue higher than last year, running about 83,000 above where we would expect. Fixed charge revenues right on target, but still higher than last year due to rate increases. And we're getting into heavy irrigation systems. It's 90 degrees outside right now.
It has been dry.
So we will start to see that tick up. Expenditures are higher than last year, about 31% of budget. We'll see that jump up as the Dundee Water Main project continues and those payments start to go out. And then annual revenue projections, when we look at that revenue only, we're still projecting about 126,000 over what we would expect for water revenue, because that's running higher this year. When we look at expenditures in that equation, we're right on target with what we were budgeting to draw that fund down by about $3 million for capital. And then the reserves at month end are at 5.4 million or 73% of operating. Give you a break from me for a moment and let's Stella talk.
Thank you. But just briefly reviewing May, it was also a very dry month, but also very cold. So the numbers were spectacular, but we were able to exceed our budgeted revenues. We did have our clubhouse groundbreaking, so thank you all for participating. It was really well received, and it also was a kickoff for Friends of the Glencoe Golf Club to start a new fundraising campaign. They did a direct mail piece to people in conjunction with the groundbreaking. And we've had quite a few smaller donations, but there are some bigger fish in the fryer right now that have come out, because once you actually break ground and prove that this is happening, it kind of excites people on the project. So stay tuned for updates on that, hopefully pretty soon. In a construction update, we did get our foundation only early start permit, and we started digging today. So we're on our way.
Moving into the other funds that we've added here, our debt service expenditures are only at 14.2% of budget. We would expect that at this time of the year because we've only made interest-only payments in June. We'll continue to aggregate property taxes in that fund, assuming they come, until December, and then we'll make debt payments in December of principal and interest, so that we'll see that number shoot up real high. Capital projects fund expenditures are only at 3% of budget. Really because we're lagging on the golf club because that just started. We'll see those payments start to come in as that project continues, and then that number will shoot up more in line with what we were expecting for budget. MFT expenditures are right on target. We talked about this last month, that we've already started expending those funds on the crosswalk improvements, and then the pension funds are also on target. We have experienced lower interest in the police pension fund this year. As Heidi was talking about, we have been experimenting and keeping a little bit more cash on hand when the property tax distributions come in, so that we don't have to liquidate investments to pay benefits. So that means we've had a little bit lower interest than what we were expecting. So we'll see how that goes over time. I think we've transferred some money back in. I'm still trying to figure out the best arrangement for that on an ongoing basis, because this is a little new for us. On the personnel side, full-time salaries and pension contributions increased since plan. There's nothing really new there that we haven't talked about in previous months. On an economic standpoint, still a lot of notifications, a lot of noise from vendors about potential tariffs, but we haven't seen anything quite yet in terms of price increases. So we'll see that tends to change by the day. Still have one vehicle that's waiting to be outfitted. So we're still experiencing labor shortages there. And we have been actively investigating alternatives for that to try and solve that problem. But overall, our commodities and our contractual services are running lower than this time last year, and still within our budgetary targets. So again, we really haven't seen, knock on wood, any unanticipated increases from inflation or tariffs yet, but we will continue to watch that. Any questions on the report?
Thank you.
Thank you. We'll move it over to Monica to talk about the CIP program. All right. So the two items that will be coming before you for consideration this month is our sustainability action plan and our EV station equipment purchase. So the first one is sustainability action plan. This is not within our CIP tracking, but I did want to include it. It will be incorporated into our future CIP planning. So I just wanted to highlight that. The EV station equipment, this is our equipment that will be going in front of Village Hall. We're breaking this into two requests or two approvals. This is just for the equipment only. So we've been working closely with the vendor, I think since late last year, on pricing out the equipment, what we're going to need. And since then, we've been working with an electrical engineer on the design side. So now we've gotten to a point where we finalized the design. We're comfortable with, what we need to purchase equipment wise. We've rechecked the prices. Like Nikki said, it's been a lot of noise as far as what we can expect with price increases. But I think we're at a point where we're comfortable making the purchase and we have locked in pricing. So we're just want to move forward with it now. We don't know what the future is going to bring. So we'll hold it on site until construction will take place this fall. So I think later this year, we'll go out to bid with the actual construction. There'll be some new electrical equipment down in the basement that will run out to those new EV stations in front of the hall. The updates to the CIP timeline. The first two are for Scott Road Bridge and Sylvan Road Bridge. These are delays from our consultant. So we're working with the consultant to get the scope of work done for the Scott Road Bridge repairs, and they just didn't have it ready. So I apologize. We're not going to have it ready until July. And then for the Sylvan Road Bridge, we have posted those plans, the construction plans for the repairs. They're out to bid. We will be opening those bids on July 8th, and they will be ready for your approval in July. The next one is our sanitary sewer rehab. This is our annual IICP program with MWRD that limits inflow and infiltration. So we work closely, our village engineer with our sewer supervisor and our consultant, RJN, to determine a scope of work each year. So there's a recommendation of here's the wish list, and then we kind of have to narrow down, okay, what can we do? What do we want to prioritize this year? So we're still coordinating that, and I think we need another month before we're ready to come to you for on that. The last one is the an update in the timeline to the technology upgrades for the SCADA network. This timeline's just been shifted. We are going to be updating the servers with SCADA. And Mario, please correct me if I say anything wrong. But we're looking at executing that in the fall just to align with the water production. So obviously irrigation is our highest pumpage. It's a busy time with the water plant in the summer, so we're waiting until that's kind of died down and we're executing that. Any questions?
Are all these projects listed here, are they, are all the projects approved in our budget listed here, or is anything missing for 2025?
The answer is yes.
Okay,
Yeah,
it's the same,
yeah.
yeah.
This is,
Okay, this is the whole.
this is your community improvement program.
Yeah, sorry.
Yeah, that's
Okay.
We've
Sorry.
we've just reorganized
I
it
understand.
to make sure it's different categories.
Okay,
So
nothing
construction.
You threw me because I talked about sustainability action plan, which is not in that
Oh,
list.
yes.
So that's, I thought that's why you're asking that. But
Oh, no.
But
It is in the budget.
it is
It
in the budget.
budget, yeah.
Operational.
And that's what I
General.
wanted to clarify. Yes, it was in the budget. It
Right.
just wasn't. Sorry.
part of the.
Didn't mean to create confusion. Thank you.
Dundee Road project.
We will have some updates tomorrow.
Okay.
We've had some delays, so I'm sure you guys have seen the electronic message boards. We were hoping to start the closure this week. We just can't get some of our subs to commit to be out here. So we're delaying the start of the closure until next week. But otherwise, it is progressing well. It's just not fun to rearrange plans and timing. So wanting to keep our residents informed on what to expect. But I think they've all had plenty of advance this morning.
So just by the changeable message boards, or are we sending?
We sent out letters.
Letters? Okay.
We've been doing
everywhere.
posts on social media, it's on our website. Right, trying to get it out as much as possible. There's been a lot of email correspondence too with Park District, School District. We've been coordinating with Ravinia, Writers Theater, our downtown district. So Amshalom, obviously they are the ones who are most significantly going to be impacted. So I've been very consistent.
All right.
Last item.
Yes. Donation.
We will remember that we do have a donation policy in our budget financial policies. So we have been fortunate enough to have a few opportunities to accept donations. And then we also have the revisiting of our Life sponsorship program for this year. So our policy does require that any possible donations come before you over various thresholds depending on the nature of the donation. And then we're looking for consensus from the committee of whether or not we can move forward with these items. So I will hand it over to Sean because he has the first two items on the list.
Sure. Thank you. Let me first, on behalf of staff, wish everyone a very happy National Fruit Vegetables Day today. I saw a few of you exchanging gifts earlier, so I presume that's what it's for. First, the two objects or items that we'll discuss by way of background. I know a number of you were involved in the approval of the purchase implementation of fixed license plate readers throughout various places in the village. So if you're not familiar with the concept, those license plate readers are stationed at key locations that monitor the vehicles entering and exiting the village. They've been absolutely probably the most successful technological implementation for public safety in a number of years. They not only allow officers or provided officers with instant notification of stolen vehicles entering the village, but they also have allowed officers to locate missing individuals, suicidal subjects that need medical attention immediately, and especially provided excellent data and an investigative tool to follow up on the crimes, most especially crimes. So in looking to capitalize off of that success, we conducted an investigation or a discussion internally and looked to see how we could expand that success. We found that you could either add additional fixed camera systems, which again operate on a contract by year, typically in a 5-year bunch, but those are fixed. Or we also found that technology is advanced. We can integrate the in-car cameras, the existing infrastructure in squad cars, in all of our squad cars as mobile automated license plate readers. So that opportunity, then expanding on that, we looked into and found that we had an opportunity through Axon, our established vendor, provides our body-worn cameras. They would create if I understand correctly, the link in between the in-car camera system and the automated license plate reader system. So that would afford us an opportunity for every time any squad car is out on the street and logged on, it would provide those officers in the field an immediate, every vehicle license plate that comes across, would automatically run it based on parameters that they would input and notify them of information that has to be. It's an incredible time-saving opportunity. It is something that's used by other communities and with great success. One of our most recent hires was using it at a South Suburban agency, and he said it just made things so much easier from a standpoint of the field. So looking at that, we considered what prices were out there, and as we found as attached, this is a referring starting in page in your packet, page 65, all the way through. We have your packet, all the way through, I believe, for the whole group of us, page 77. We received a price quote as it was something that the Glencoe Public Safety Foundation had expressed an interest in the past in supporting. We approached and they approved for a total amount of $23,313.04. That contract, we're suggesting that we initiate this as a pilot program. That's going to be married to the same for our existing program that's already in place. They have agreed to fund it for that amount. It falls below the $25,000 approved threshold that we can accept without approval, but since it's such a significant donation and something that is impactful, we think get your attention. So with that, it would be added to. It is simply just a matter of software. It's not hardware. It will link the two systems, and we can implement it almost immediately with your approval. Then, if we do feel that it's something that is beneficial, that has a value to it, then we'll be adding it in subsequent years with the CIP. That's the first subject.
You can round your approval to the nearest dollar. Okay.
Yeah, I said it was 4 cents. It was 4 cents for Nikki's benefit.
As an accountant, I can't believe what I'm hearing. Okay.
So the second item for discussion or mentioning is another success story, and this is something that kind of goes along with something we see every single day with public safety and the community engagement. In a recent visit, we were hosting some family, the Carlix family. They were bringing their children to the station, and they were doing the station tour. In the course of doing the station tour, they saw the construction. And a conversation was struck up with Mr. Phil Carlitz. Mr. Phil Carlitz had learned that we were not only doing work on the first floor, but we were also doing work on the second floor. At which point he had offered, he expressed that he's the owner of Illinois Sleep Products. It's a mattress company in the city of Chicago. And he offered to donate mattress, or allowed basically essentially a purchase at cost for 7 mattresses. Pricing out those mattresses, they would be 7 13-inch twin XL mattresses. They would be priced out at $13,286 we advertised. He's offering for us to purchase them at a cost of $238 each. That would equate to a donation to the department of $11,620. In such, we would request your approval. This is something that Mr. Carlitz does. It's my understanding. Yeah.
Are they comfortable?
You've been waiting. I've been waiting all day.
Oh, it's gonna be a long week.
They're incredibly comfortable. I have not tried them, but I will say this. I know Mr. Carlitz has done, his company has donated a number of different times for other law enforcement agencies.
Okay, good. As long as they try.
Yeah, so it's an excellent product. The staff conducted a thorough research, and this is the type of mattress that they were looking to purchase from another vendor. And it just so happened that during this visit happened, and he offered just based on conversation. So again, this is another really, really excellent example of just the community seeking to support the department. Do you have any questions on either?
For the license plate reader system, currently we're collecting plates coming in and out of Glencoe
Yes,
at every entry point.
not every, but at key locations.
Okay.
So this would augment.
This was kind of, all right, I was wondering, like, why would we need
Yeah.
more if we're already getting,
Yeah.
but, okay.
Ultimately, further on down the road, there are some gaps in areas that I would like to close. So I think this is part
Well,
of it.
this is fine, yeah.
And this
part
is actually, when you compare, this is actually a more affordable version than adding additional fixed. But ultimately, I'd like to see a few other gaps closed down. It is, I can say, in my experience, it is an absolute game changer for the public, from a public safety perspective.
Thank you.
Moving on to the golf. In accordance with the donation policy, staff is seeking approval of naming rights in association with the donation for a portion of the new Glencoe Golf Clubhouse. The Goodman family has generously donated earmarked $1.5 million donation, and they would like to name the private event space for Ellis Goodman, who passed last year. This event space is facing north and has like the meeting room and can seat 50 people. And will also overlook the new croquet court. So they thought that was an ideal space to honor Ellis. And so we are looking for approval for naming for that space.
We- Absolutely. That sounds,
Sounds good to me.
very, very.
Great.
Can we like motion second voting or what?
We just
Yeah,
need
yeah, yeah.
consensus from the committee.
Absolutely. Overwhelming consensus and appreciation from the committee.
Yes, thank you.
Let the record show.
I'm assuming we're okay, consensus with public safety. I can see.
Yes.
Okay, great.
Yes, and appreciate the spirit of coming. It's below the limit, but appreciate hearing that. Thank you.
Just one comment. So if we do get a donation less than the threshold, are we notified just anyway, like a consent or in a memo or?
We haven't had the situation really come up yet. But Phil and I were talking, it's been a while since we did the original donation policy. And we're coming up next month on the review of the donation policy of what we will be changing going forward. So that would be feedback that we would want from the committee when you want.
I would say
Somehow.
generally, we haven't received any. Right? Part of what we're talking about is these are donations that are being made to the Friends of the Glencoe Golf Club that ultimately will be made to the village. But because this has a naming attached to it, we wanted to make sure you guys were all comfortable with that. I would say as we get to a place where the Friends are making a distribution, that's what we would then at that point kind of share with you the list of those contributions that make up that block of cash, whatever that donation would be.
But the point about Public Safety Foundation is we did, when the Public Safety Foundation came to the Finance Committee, the committee set a threshold of 25,000, and that went to the village board for approval. So there have been donations from the Public Safety Foundation that have been under that threshold. One of them was for gear bags, right, or first aid kits.
First aid kits and training with the FBI, and now this section.
So in this one's 24,000, so we're just
Well,
saying,
To some degree, we brought this to you because of the nature of what it is. No, it's the nature of what it is and the fact that there could be an ongoing cost associated with it. So we wanted to make sure that before we said, because this one does fall under that threshold, it wouldn't necessarily require the conversation tonight.
And the first payment would be covered, but this is I think a 41-month agreement, right?
Yes.
Yeah.
So then the ongoing cost, the village would take that on. So that we wanted to bring that to the committee, just so you understood.
But to that end, relative to those ongoing, whatever those ongoing smaller donations coming from the Public Safety Foundation, we will, I think we should annotate those perhaps in the treasurer's report in the month that they're received.
The Public Safety Foundation.
Right, right. We could just included it in part of the
you
narrative.
know, if you have a donation that's just short of the reporting number, you probably should keep us posted. I mean, I'm thinking about, okay, if you come into the country with $10,000 and so you have all this stuff at $9,999.
Well, that's fair,
We should just,
except for the fact that why have a threshold then?
I get it, but if it's close, the answer is,
Right.
you know,
I don't think there's
I just
any-
don't want to clutter the
Yeah.
committee
No,
with,
I think.
but if that's how you guys
We're-
want us to do it, we're happy to do it that way.
Right, unless you think, I mean, if you think we ought to have, if you use your judgment and think we ought to have a discussion about it because of the nature of it, or because, oh, this is the third one from the same person.
Sure.
You know, it's the monthly withdrawal of the $9,900 so that you don't hit the $10,000 limit kind of thing. That's one thing. We should only be so lucky, right? That people want to give that much money. But otherwise, I think noting it in the treasurer's report so we can take a look, and then if we have any questions, we'll raise them.
We can work on modifying
If
the
that's okay.
language in the policy next
Is that
month
right?
and make some recommendations
Yeah,
on how we
I-
incorporate this feedback.
I may be the least troubled of anyone in terms of getting these donations.
How are you on claims?
Because we don't have a lot of pennies that we can hand out in exchange for this largesse. I mean,
But we really have none.
I mean, so if our public safety department gets, you know, LPR cameras or mattresses, you know, what are they gonna do for the donor? I mean, you know, we're not letting them do bank
Well,
robberies, right?
understand, if you remember, the foundation does have, there are tiers of things
Sure.
that a donor could get. And those things are generally lunch with the chief or a
Yeah.
tour of the public safety department or things like that. That's all very clearly delineated in those materials. We can look at, I totally understand your point, particularly on a recurring basis. As these happen, and they happen to happen frequently, we can make that report, if nothing else. As I said, even if we just include it in the treasurer's report so that it's delineated somewhere.
And basically, I'm in favor of saying to anybody that gives us stuff, thank you, we are grateful,
Yeah.
and we don't think you have ulterior motives,
Yeah.
because we can't figure out what they would be. You know, they're just being
It's more
public
just
spirit.
to know, to be grateful and say, oh, this is great.
Yeah,
Than thinking anything
Yeah.
suspicious in those mornings.
if nothing else, just making sure there's some public recognition of
This is a
their
unique-
generosity.
Yeah.
This is a unique situation. I just want to point out for the record that we have people that are giving us money.
Yeah,
willingly over and above what they are already required to. So yes, I agree, finding a way to be creative, to add that gratitude into the
Yeah.
public process.
yeah, yeah.
Yeah, it sure is.
Okay. Last but not least, staff is seeking approval for the annual Light the Light sponsorship program. For the donation policy, Finance Committee approves any sponsorship programs that we offer. The program is going to remain relatively the same as the previous ones that have been presented to you guys, different tiers of availability to businesses to sponsor the event. We're coming to you guys a little bit earlier this year because we do want to extend the amount of marketing exposure for the businesses, being able to put our logo in Inside Glencoe for the next season and all that fun stuff. So we're talking about Light the Lights in June. So.
And no, and kudos for thinking ahead and then expanding our potential marketing. That's great.
I'm happy to answer any questions about the program, if there's any concerns about how we've done in the past. Or...
Grateful for our sponsors.
Yeah. And how successful the event is.
They have made it.
Hopefully it'll be less
Much
cold
more.
this year.
Yeah, I was gonna say, if they could start donating warmth, that would be good.
Came earliest today.
Yeah, I was gonna say, it's here.
Yeah.
We'll just have Light the Lights tomorrow.
All right. Any other items that either of you would like to bring in, or you, sir? Or anybody?
Good job. So in the first presentation, we were sort of applauded because of the level of spending projects compared to our finances. That's likely to change this year because all of a sudden we're going to spend a boatload on the clubhouse.
I mean, as we begin to spend down those bond resources, yeah, I mean, I think we did the $12 million bond, was that in last year?
This is
That's what I was gonna say, so it's, I was gonna say, it's been,
You just got the
so
Two
those resources aren't even in that audit.
Right, no, I'm saying, that's what I'm saying. It's going to look different with the next report because all of a sudden we're spending.
the money that we intended
Yeah.
to.
I mean, it's not a surprise.
This year we'll have, significant spend down of water fund bond resources with the big water main projects and things like that. So
I think that'll be the most significant change because we were planning for it all. We kind of budgeted for the bond proceeds and we budgeted for the expense. But this year, we're halfway through the year and our projections are still holding that we're going to be actually drawing down general fund balance and actually drawing down water fund balance, which has been not the case for
Right.
the past few years. So that would be, I guess, the trickiest thing in a rating call to explain, we've had all these surpluses year over year. Why now? Why now are you drawing? And as long as we can substantiate those expenses, that they're within policy and they're one-time capital expenses and we're not using it for operating,
Right, that's
they're okay with it.
the critical, is that our
But it will
operating
be a
revenues
stark
versus expenses.
difference from what we've seen.
I mean, last year was a lot closer than we had seen in the previous couple of years. We've also just had really robust revenue years, which again, these are blessings. Nikki pointed it out. Our unrestricted fund balance since 2016 has increased $12 million. That is a policy difference. I mean, that was very clearly a policy shift on the village board's part. Those kinds of modifications have only been possible really because our revenue environment has been as strong as it has. But we know we need those dollars too. So that's the management now, as we've talked with the financial forecast, which we'll see in September. Yeah.
Which goes also to the conversations we've had prior to this year, and I know they're being studied about what's next, what's the low hanging fruit for
Other revenues.
other revenues that were previously not available to us.
And if you remember, I mean, there's a strategic plan initiative to work to bring our reliance on property taxes to 50% or below, or 55%-ish, 52 to 50. Yeah, it all depends on the year. It kind of moves up a little bit or down. But so that's kind of along those same lines, right? How do we limit that reliance on that property tax bill, especially recognizing, as we talked about tonight, those bills are not doing anything but going sky high. So that's the other reality of things, is that we want to do as much as we can to limit the reason that the village is impacting that.
Right. Our EAV is becoming a higher percentage of the total EAV of other municipalities, bodies that are included within our property tax bill.
Totally.
It's not just that, oh yeah, whatever, our net spending has gone up a bit with inflation or the school district, all which is with the Glencoe. It's, oh yeah, our share of the county.
Yes.
Right?
Yes, that's right.
That kind of thing.
I think that's a really good distinction that is easy to, it's just hard to understand and it's easy to overlook.
Yeah.
Is that we play a bigger and bigger role in that overall.
Right.
I mean, we have, I've said this before, we have an EAV that rivals communities substantially larger than us with substantially more diverse tax bases than we do. I mean, this is a bedroom community, right? It's nearly 90% residential. That we have an EAV at the level that we do is, it speaks to the value of those residential properties, which kind of ties into what we heard from the assessor last week.
And it's also important to note, when, setting aside that continued bump in EAV is also due, I believe, in material part, I truly believe this, to you and you and you and you and you and all of you, even you, in terms of delivering the kind of governmental services and thoughtful planning and infrastructure developments and how we run things around here. It makes a huge difference as to, oh yeah, people want to live here and people want to keep living here, then guess what happens to the price left? It's not just because of nothing. It's macro, it's all macro. No, there's a hell of a lot of, some macro, but there's a lot of local. And we appreciate it.
That's true, even though any resident that comes to complain to us about anything says we're going to take their property bill.
Yes, that's true. That's true.
That just goes with getting up in the morning.
And kill their children.
Listen, I've been a Jewish husband for 40 plus years. Everything's my fault. I accept that. All right, seriously, if there's nothing else, then thank you all for staying so late. Thank you for the efficiency of all that work we just got done. Motion to adjourn, please.
Second.
All in favor? Aye, we are adjourned.
Thank you. Productive meeting.